In this lecture, we will cover the accounting for investments. Note that the accounting for investments depends on the level of ownership. An investor may have a passive investment, significant influence, or control over the investee. Let's begin with passive investments. An investment without significant influence over the investee is considered as a passive investment. Generally, debt investments and stock investments of less than 20% of shares outstanding are considered as passive investments. The categories of passive investments are: 1. Trading securities. These are investments that are actively traded to take advantage of short-term changes in prices. Trading securities are reported at their fair value or market value on the balance sheet. 2. Available for sale securities. Available for sale securities investments are not actively traded and they are held for longer periods. They are also reported at their fair market value on the balance sheet. 3. Held to maturity securities. Held to maturity securities are debt securities such as bonds, which are intended to be held until maturity. Held to maturity investments are reported at their amortized cost on the balance sheet. Note that an unrealized holding gain or loss is an increase or decrease in the market value of trading or available for sale securities that are still owned by the investor. Unrealized holding gains and losses related to trading securities are reported in the current year income statements. Note that unrealized holding gains and losses related to available for sale securities are reported as part of a separate component of stockholders' equity called accumulated other comprehensive income, or AOCI. Note that any realized gain or loss is recognized in the income statement when an investment is sold. Let's now discuss investments with significant influence. The equity method of accounting is used for investments with significant influence. Investments between 20% to 50% of the outstanding common stock of an investee typically convey significant influence. The investor with significant influence has the ability to affect the financing, investing, and operating policies of the subsidiary. Note that the company does not control the subsidiary, as the ownership level is not more than 50%. Now note that equity method earnings are computed as the reported net income of the investee multiplied by the percentage of the outstanding common stock owned by the investor. Also note that dividends received from the investee are treated as a return of investment. That implies dividends received are subtracted from the equity method investment account. In contrast to the fair value method of accounting for passive investments, the equity method investor company does not report investments at market value. Note that equity method investments are reported at adjusted cost, and the adjusted cost is the original purchase price plus or minus the proportionate share of the investee's profits or losses less dividends received. Let's now review two examples that illustrate the equity method of accounting. In example 1, Company A owns 30% of the outstanding stock of Company B. Therefore, significant influence is presumed, and the investment must be accounted for using the equity method. If Company B reports net income of 100,000, Company A recognizes equity method earnings of 30,000. Now we get the 30,000 by multiplying 100,000 by 0.3, which represents the level of ownership. In example 2, Company A owns 25% of the outstanding stock of Company B. Once again, significant influence is presumed, and the investment must be accounted for using the equity method. If Company B declares and pays dividends of 100,000, Company A recognizes dividends of 25,000, and we get the 25,000 by multiplying 100,000 by the level of ownership, which is 25%. The investment balance should therefore be reduced by 25,000. We will now discuss investments representing more than 50% ownership. A stock investment representing more than 50% of the investee company's voting stock is generally viewed as conferring control over the investee. The investor and investee financial statements must be consolidated for financial reporting purposes. Consolidated financial statements portray the financial position, operating results, and cash flows of affiliated companies as a single economic unit, so that the scope of the entire entity is more realistically conveyed. The consolidation process merely replaces the investment account with the actual assets and liabilities to which it relates. In a consolidation, all intercompany items are eliminated so that the consolidated statements show only the interests of outsiders. Let's now consider the preparation of a consolidated financial statement for a wholly owned subsidiary, that is 100% ownership. Note that the assets and liability accounts of the parent company and the subsidiary are combined in the consolidated financial statement. For example, current assets for the consolidated financial statement will be 5,000 plus 2,000 equals 7,000. Note that the following will be eliminated. 1. The investment account on the balance sheet of the parent company, which is 2,000. 2. The subsidiaries' equity accounts, which are 1,500 common stock and 500 retained earnings. Let's now consider consolidation when ownership is less than 100%. Again, the asset and liability accounts of the parent company and the subsidiary are combined in the consolidated financial statements. For example, total current assets in the consolidated financial statement will be 5,000 plus 2,000 equals 7,000. Note that the investment account on the balance sheet of the parent company is 1,600, reflecting 80% ownership of the subsidiary. That implies there is a minority ownership or non-controlling interest of 400 in the subsidiary. To consolidate, we again eliminate the 1,600 investment account as well as the subsidiaries' equity accounts, which are 1,500 common stock and the 500 retained earnings. We then include the non-controlling interest of 400 to complete the consolidation process. I end this lesson by noting that there is a possibility that consolidation could mask the weak performances of companies, and the ratios calculated from consolidated statements might prove deceptive as they are composites or weighted averages across various business segments.